Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities, joins us now. So I think what we've seen this week, and you heard Rick, Savita, it's based on whether we've got inflation really back in the bottle. Do
right.
we?
Right.
Do we have it under control?
I don't think so.
Then should we be cutting?
Well, I'm not the Fed, but I think that where we are right now is an environment where we have a real high probability of seeing a reflationary environment next year, right? We just had 3 pro-cyclical things happen over the course of the last couple of quarters. One, profits troughed and are accelerating again. That's pro-cyclical. We've got demand recovering. We've got the market broadening. 2, the Fed is cutting interest rates into an accelerating growth environment, which is very unusual. Typically, the Fed is accommodative when things are slowing. And this time we've got profits growth actually picking up pretty demonstrably. And then on top of that, we have a red sweep, Trump 2.0. Sure, there's tariff risk and there's, other aspects of this that are uncertain, but we have an administration in place that is pro-business, anti-regulation, pro-cyclical. I mean, I think it's hard to argue that we're not going to see a little bit of a reflationary cycle next year.
I would think the only reason that the Fed would be so dead set on lowering rates is that maybe there's something that they see in the underlying economy.
Maybe. I mean,
like what?
I don't know what it is. I mean, maybe a little bit of fraying in
It's a dual mandate.
Yeah, right.
I don't think that the slowing economy side of that, or the unemployment side of that, is as much of a risk right now as the inflation side. So I don't know why they do it. Why are they disagreeing with what I think? I
mean, we are seeing a slowdown in some of the really hot measures. Well, I mean, if you look at like delinquencies, they're slowly rising from super low levels. The consumer looked ultra healthy, and now they look slightly less healthy, but still great, right? So I think that a lot of these factors, when you look at them, just over the last couple of years, you can point to a number of macro indicators that are slowing, but they're slowing from really, really healthy, kind of aggressively healthy levels. So, again, when I look at the world, I think you got to be prepared for anything, especially a resurgence in inflation. My favorite part of the U.S. equity market, I have one trade for you, and it is the large cap value benchmark.
Okay.
It's very unsexy.
Can I hide
Nobody
there?
talks about it. What's that?
Can I hide there? Is that?
Well, it's not even to hide. I think this is going to be a great performer over the next, cycle. Because if you think about it, these were companies that were deprived of capital for the last 10 to 15 years. It's energy, big financials, regulated financial companies that weren't allowed to grow, energy companies that were forced to, pivot from production to cash return. So they're now really healthy. I'm a quant, so I look at all these numbers. What's surprising to me is if you look at just the earnings volatility of the value benchmark versus the growth benchmark, usually growth stocks are safer and you get safer, kind of more predictable earnings growth. Today, growth stocks are riskier and value stocks are safer. And I think it's because value did the opposite of growth. They shored up capital. They cleaned up their balance sheets. These companies were basically kind of schooled by investors to cut capacity and consolidate. And today we've got this super healthy, high quality, cyclical sector with 3 pro-cyclical things that just happened that, we mentioned earlier. I mean, I kind of feel like this is the perfect setup for large value to just really crush it.
I had a flashback because you switched to this thesis. How long ago was it? About
6 months ago.
Was it 6 months? And
yeah.
I remember how excited you were.
I was really excited. And I mean, so far, so good, I have to say.
So it's been working.
Except for the last month.
It's been working, but there's more left.
I think there's a lot more to go. I mean, if you look at value versus growth, we've had mostly outperformance from value stocks. It pays to buy cheap stocks. The only time it didn't work to be a value investor is when rates were 0 and cash was worthless. And it's like, who cares if I'm making free cash flow? I can just buy anything with a 0 hurdle rate, borrow money for free, do a lot of crazy things.
That is an excellent point.
Right?
So if we're not going back to 0 rates.
Unless we're going to 0 again, I say this ends now.
Yeah, the Fed's about to stop cutting rates.
Exactly.
Maybe it makes it pulls it forward in terms of the thinking on it.
If I were the Fed, and if I, it's still being like pilloried for staying at zero for too long, right? And for letting inflation out of the bag. And you look at the results of the election and what it did to the Biden administration, everything that they say was great that happened. But when you throw inflation in it, it like cancels almost everything out because, average wages are still down. If I knew how insidious it was to the average American, that would be front and center for me all the time. And where we are right now would not give me the confidence to cut.
Yeah, I mean, I think that's a great point.
That would be job one, not letting that come back
with a vengeance. I mean, I think that there are enough maybe counterbalances to really kind of keep inflation at bay.
You think it's equal risk? The dual mandate,
I mean,
you think?
One could argue that we're still in that, kind of environment where there's tech, which is disinflationary. So there's AI, which is potentially going to push down wages in certain pockets of the market.
So productivity cures are...
I mean, that's the theory, right? I think there are parts of the economic spectrum that could really reflate quite quickly, especially because we've got this massive reshoring initiative and manufacturing is now happening here.
Tax cuts. And
tariffs. I mean, I don't know if
deportation.
I think tax cuts are actually disinflationary.
You do?
Yeah. Because when you look at what happened...
The deficit widens, they're not.
The deficit widens, but then theoretically there's better growth. And then also, the last time we got a
God, you're a supply-sider. When did this happen?
Hey, I don't know. I've been doing
vote for?
long enough. We can't talk about who we voted for, Joe. Right. Come on.
You like tax cuts.
But look, I mean, last time we got tax cuts, companies basically passed that on to consumers through lower prices. So it's disinflationary.